Hey folks, we got a question from one of our investors. They asked us to drill down a little bit deeper on a video we did I think a month or so ago about the biggest risk to the stock market now that nobody seems to be talking about. We've got a lot of talking heads on the media all the time, and there's always people that are Pollyanna and, we're off to the races and stock market's going to keep going up double digits for another 10 or 15 years. Don't worry about a thing. And then on the other extreme, you got the doom and gloomers that say, it's going to go down 50% or more and we're in big trouble. No one knows what the stock market's going to do short term. It's always gone way up long term if you can hang on long enough. And that's the key, because I'd like you to know about, I think you'd want to know about, one of the biggest risks that no one's talking about is the doom and gloomers aren't right and the Pollyannas aren't right. It's somewhere in between. Frankly, the market goes sideways for a long period of time and doesn't return much, which it tends to do. I'm going to ask my Crackerjack marketing team to pop up that slide over my shoulder that talks about flat markets over bull markets. Man, there's been a lot of times throughout history and in my adult lifetime, investment lifetime, where the stock market's done nothing for years. From 2000 to 2010, a whole decade, the S&P 500 returned like 1.5%. It was after the big run up before the tech bust, right? The Dow Jones Industrial Average from 66 to 1982, 16 years went sideways, violently up and down and all over the place, no return. The Nikkei index in Japan for 35 years, from the late 80s till just a few years ago, didn't even make a new high for 35 years. Not knowing that's going to happen for sure, but it could happen. And why? Because things are stretched valuations right now. Dividend yields are low. Market's done really well the last 10 or 15 years. Maybe it needs to digest a lot of this and let the earnings catch up. For those of you who don't know me, hi, my name is Fred Hanish. I'm the owner of Old Drake LLC, and we are investment advisors for clients and investors that don't much like investment advisors. Not personal, but they don't like paying 1% on the assets under management in their portfolio. They don't like paying all those fees. They don't like paying a second layer of fees that the advisor puts them in somebody else's mutual funds, and there's another layer of fees. And they don't like paying a lot of taxes on the gains when they get them. So that's some of the reasons people don't like financial advisors. That, and they're not 100% transparent. So we advertise ourselves because we're a flat fixed fee. We only charge $5,000 a year, and we're fully 100% transparent. You're a client of ours. You're going to know where every fee is and who's getting paid. And you need to know who's getting paid, because that tells you what their motivations are. But more importantly today, for clients, this particular client that asked that question he's retired and in his late 60s. And we have clients in their 30s and we have clients in their 80s. Most of our clients are 50, 60, 70 years old. Some are retired. Many are getting ready to retire. And they're worried. What if the stock market does go sideways for 5, 10 years? What if it goes down 30, 40, 50% before it comes back and it takes a few years? That's a legitimate worry and concern. So that's what we're going to talk about today. I've got some notes here of how we combat that I want to share with you, because there's a lot of people out there. There's a lot of people out there that don't know the stock market. They don't even remember the 08-09 Great Financial Recession, let alone the tech wreck of 2000 to 2002. Some of us old codgers have been around here. We've been through some nasty markets. We know what the market can do. Mr. Market can take a header and soil his pants sometimes when you least expect it. And it can last a long time, unfortunately. And I'm worried that a whole generation of investors is going to have to relearn that. So what do we do to combat that? Well, number one thing, control the controllables. I've harped a lot on that whiteboard behind me, but if you can reduce your assets under management fees and go with a flat fee advisor, a shop like ours, yours truly, a shameless plug, but every client of ours can save usually at least $5,000 a year, but some of them are saving 10, 20. We have a client saying saves them $40,000 a year. Now that's a portfolio a little over $5 million. So that's number one. If you can decrease one of your largest expenses, one of your largest overheads is paying 1% on your millions of dollars to a wealth manager before they add on all the other fees, that's pretty substantial. It's pretty stout. But that's small potatoes compared to, we like to put people and invest their money in individual securities. So we don't pay a second layer of fees. And we don't pay a lot of taxes around here, because when you own individual securities, you can actually tax manage and mitigate taxes all year long. And we're a boutique. We only can take on a small number of clients, which we like and our clients love. We can manage your taxes all year long and mitigate taxes with any buys and sells and trades we're going to make in the account. So control the controllables, mitigate your taxes, mitigate the fees on the products your wealth manager is putting you in our case, almost none, because most of our clients have most of their money in individual securities where there is no second layer of fees. And if you can reduce your wealth manager fee to a flat fee versus, we got clients, again, saving $5,000, $10,000, $20,000 a year or more. But we also specialize in a portfolio around here of household name companies that sell products you and I have to have every day, like gasoline for our car. And if you got kids or grandkids, diapers and toothpaste, things that people must have and must own. And those are companies that pay big, juicy dividends. That portfolio yields like 4.2%. You know what the yield is on the S&P 500 today? 1.2. For those of you that are CPAs and engineers out there, the S&P is still trading at 20.5 times earnings today. Not exactly cheap. Our portfolio is more like 16.5. So if you can buy something at a 25% discount to the market, that's good value. If it's yielding 3 times what the S&P 500 is, a lot of our clients can live off that 4.5, 5.5, 6%. And in 5 or 10 years, it's going to turn into 8% a year, 9% a year, 10% a year. Because companies we invest in increase their dividends all the time. Usually every quarter, but certainly every year. Twice as fast as the rate of inflation. We're not too big on fixed income around here. That doesn't sound like much fun. 90% of the bonds out there today in the world have a coupon of 5% or less. Ooh, and frankly, bonds haven't diversified from stocks very well since COVID. And so forth. So we have a lot of clients that own their own rental properties or they own commercial real estate. We like cash flowing land, but good real estate that pays income that grows over time faster than the rate of inflation. Dividend growing stocks that pay 4% or more and grow that dividend over time, no matter what the value of the underlying stock portfolio or even the real estate. If it goes down, it'll come back. You can wait for it to come back. And if you're not retired and you don't need to live off the 4, 5, 6, 8, 9, 10% yield without ever having to worry about touching your principal, it's even better because in your IRA, just have the dividends go back and buy more shares. In fact, if you're 30 or 40 years old, I tell my kids who are in their late 20s, you actually don't want the stock market to go up. You do want it to go sideways or down for 5 or 10 years. Me, not so much. So control the controllables, reduce your overhead, reduce your taxes, reduce your fees. We can show you how to do that. At the end here, in fact, there's just a free money planning quiz. It's going to take you about 3-4 minutes, ask her 8 or 10 questions. If you do that, I promise I'll send you a personalized video just for you responding to your situation. And if you want to go through and find out how much money you can save on your wealth management fees, on the fees that your wealth manager's products they're putting you in, and tax mitigation, we'd be happy to do that for you as well, do a little discovery for you. So that's our value add promise to you. Subscribe to us on YouTube, like us on Facebook. It helps us out. We would appreciate that. But by all means, take that quiz and I'll get back to you with a personalized video just for you. Thanks for listening.